Picture a massive crowd sprinting away from a sudden downpour in a busy city square. It looks like pure, unpredictable chaos.
Yeah, completely random.
Exactly. People are bumping into each other, umbrellas are flying, just completely random movement. But what if I told you that crowd's movement wasn't random at all? What if that panic was actually, expanding and contracting according to ancient quantifiable mathematical ratios?
Right.
Today, we are doing a deep dive into the, highly debated, fiercely rigorous world of harmonic trading. Specifically, we're looking at the comprehensive methodology pioneered by Scott Carney. And our mission today, we want to find out if the financial markets are truly just a chaotic sea of random price movements, or if our collective greed and fear are just biological algorithms dancing to a strict mathematical beat.
It really is, it's a complete paradigm shift in how you view human behavior.
Yeah.
Because most retail traders, they operate purely on this emotional roller coaster. They see a massive green streak on a stock chart, and the fear of missing out kicks in, and they just blindly buy at the very top.
Right, the classic FOMO.
Exactly, FOMO. Or, the pain of a crash gets to be too much and they panic sell at the absolute bottom. But harmonic trading, it's designed to completely strip that emotion away by revealing the hidden architecture behind all that panic.
Okay, let's unpack this, because I have to play devil's advocate right out of the gate here.
Sure, go for it.
To a lot of our listeners, the idea of drawing geometric shapes and, Fibonacci numbers on a stock chart, it sounds a little bit like financial astrology or like reading tea leaves. Why is this actual science and not just, confirmation bias? How does a random trader's messy panic translate into exact math?
That is the perfect question to start with, because frankly, skepticism is required here.
Good.
It's not magic, right? It's about natural growth structures. The Fibonacci sequence and the golden ratio, that 1.618 number, they aren't arbitrary numbers Carney just pulled out of thin air.
Right.
They govern the spiral of a nautilus shell, they govern the arrangement of seeds in a sunflower, and even the proportions of the human body.
Oh, wow, okay.
Yeah, so the core philosophy here is that financial markets are really just massive aggregates of human psychology. And humans, being a part of nature, we express our collective anxiety, our greed, and our relief in these same naturally occurring measurable ratios.
So the market is constantly trying to find this natural balance. And when price moves too far in one direction, driven by all that messy human emotion you mentioned,
Yeah.
it creates kind of energetic imbalance.
Precisely. And these harmonic patterns are essentially visual maps of that energy expanding and contracting. But, and this is key, it is vital to understand that this isn't just, slapping a Fibonacci tool on a chart and crossing your fingers for a bounce.
Right.
That is exactly what amateurs do, and it's why they fail.
Which brings us to the foundational concept of this entire system, which is the potential reversal zone, or the PRZ.
Right, the PRZ.
And to really grasp what a PRZ is,
Yeah.
I think we have to look at the biggest mistake novice traders make, which is hunting for a single magical price point to buy or sell.
The single price point fallacy. It is a fatal error in trading. The financial market is a massive, highly liquid auction with millions of participants. I mean, billions of dollars are changing hands every second. Momentum carries immense weight. You cannot expect a freight train of market momentum to just stop on a dime at one exact penny just because you drew a mathematical line there.
The source material uses this incredible analogy for this that completely clicked for me. Imagine you're trying to catch a heavy metal safe plummeting out of a window toward you.
Right.
You wouldn't try to catch that safe with one single string. That string is going to snap instantly under the momentum. You would want a deeply woven net made of multiple thick intersecting ropes.
And that woven net is your PRZ. To build that net mathematically, you aren't looking at just one measurement.
Okay.
You are calculating the retracement of the initial movement. You are calculating the extension of the secondary movement. You're layering in proportional symmetry, like the AB equals CD pattern.
Right.
When 3 or 4 of these distinct mathematical calculations all point to a tight overlapping cluster of prices, that's when you draw a box on your chart around that cluster.
And that box is the net. It's a highly probable area where that falling safe is finally going to lose its downward momentum and actually bounce.
Exactly. What's fascinating here is how this entirely changes the psychological posture of the trader.
How so?
Well, they stop reacting and they start anticipating. You don't try to guess where the market is going early. You draw your PRZ box and you basically sit on your hands.
You just wait.
You wait patiently for the price to drop or rally into that exact mathematical window, and only then do you engage.
Let's ground some of this visual jargon so we can actually picture it in our heads. A lot of this methodology assigns this exact math to shapes that look like an M or a W on a price chart.
Yep.
So imagine tracing a zigzag on a piece of paper. The market makes a massive leap upward. That's your first line, what the methodology calls the X to A leg. But, nothing goes up forever, so it takes a breather and dips down. That dip is your B point.
Yeah.
And the granddaddy of all these zigzag patterns is the Gartly pattern.
Yes, originally introduced decades ago by H.M. Gartly, but in its original form, it was incredibly vague.
Oh, really?
Yeah, people were just squinting at charts, looking for anything that resembled an M or a W and just crossing their fingers. It was entirely subjective.
So how did this system, Carney's system, fix that?
By assigning unbreakable, rigorous Fibonacci ratios to those zigzags. So in a bullish Gartly, you have that initial strong upward move, the X to A leg. Then it pulls back to point B, the strict rule. That B point must retrace exactly 61.8% or 0.618 of that initial move.
Wow.
If it pulls back 50% or 78%, it is completely invalid as a Gartly. It has to be 0.618.
Precision is absolute law.
It has to be. After that specific B point, the price rallies a bit, and then does a final washout drop down to point D, which is your buy zone inside that PRZ box.
Okay.
And that D point completes at exactly the 0.786 retracement of the original move. When you see this exact geometry, you are looking at the footprint of institutional algorithms. It tells you the market has shaken out the weak, fearful retail traders in a deep correction, but has mathematically preserved the primary upward trend.
Wait, I'm looking at my notes here in this next pattern. The bat pattern, it looks almost exactly like the Gartly. They are both M shapes on a chart. If I'm a trader, how on earth am I supposed to tell the difference in real time without just guessing?
You look at the depth of that very first dip, the B point. And this is really a brilliant psychological masterclass. In the Gartly, we said that first dip was a deep 0.618 retracement.
Right.
But in the bat pattern, that initial pullback is much shallower. It barely dips at all, usually stopping at a 0.50 or ideally a 0.382 retracement.
Here's where it gets really interesting, because that shallow dip is actually a massive trap for amateurs, right?
A brutal trap. Think about the psychology of a retail trader watching a chart. The market shoots up and then it barely dips. It holds its ground.
Yeah.
The amateur sees that shallow pullback and thinks, oh, wow, the market is incredibly strong. There are no sellers here. This thing is about to rip to new all-time highs.
So they get aggressive. They buy in heavily, taking on huge risk because they are just terrified of missing the rocket ship.
And right as they buy in, the market suddenly fails and begins a massive, terrifying plunge toward the D point. And in a bat pattern, that final D point isn't a normal correction. It drops all the way down to a staggering 0.886 retracement of the original move.
Oh, man.
It basically retraces 90% of the entire rally.
To a retail trader who just bought the shallow dip, that doesn't feel like a correction. That feels like an absolute market crash, like the sky is falling.
Which forces total capitulation. The pain of the loss becomes too great, and the amateurs panic, sell all their positions at the absolute bottom just to make the hurting stop.
Right.
But the educated harmonic trader, they aren't panicking. They've already drawn their PRZ net at that exact 0.886 level because they measured that shallow B point days ago. They know the entire drop was a mechanical trap designed to force retail capitulation.
That takes a terrifying amount of emotional discipline to be the one calmly stepping in and buying at the 0.886 level while the rest of the world is screaming and throwing their shares out the window.
It does, but you do it because the math tells you the trap has mathematically completed.
That makes total sense for markets that are just, bouncing back and forth within a range. But what happens when the market goes parabolic? What if it breaks out wildly to new extreme highs or lows? Because those standard M and W shapes wouldn't really apply there.
That is where the extension patterns come into play, specifically the butterfly and the crab. These are designed to catch major historic market tops and bottoms where the price actually pushes far past the original starting point of the pattern.
Let's look at the crab pattern, because the source text describes it as the absolute most extreme, violent pattern in the harmonic universe. It creates what they call face-melting reversals.
It really does. Like the bat, the crab starts with a shallow B-point trap. But its final push doesn't just retrace, it extends relentlessly. It blasts past the original high and stretches all the way to a 1.618 extension. And the internal proportions of the pattern often project out to massive 2.618 or 3.618 extensions.
I want to pause on those numbers for a second because we need to explain the mechanics of why a market stretches that far. Why does a crab pattern reach a 1.618 extension? It's not just magic gravity. It's driven by the actual physics of the market, like short squeezes and margin calls, right?
Exactly. Let's look at a short squeeze. When traders bet that a stock is going to go down, they borrow shares to sell them, hoping to buy them back cheaper later.
Right, that's shorting.
Yes. But if the stock suddenly breaks out to a new high, those short sellers are suddenly losing huge amounts of money.
And their brokers basically step in and say, hey, you don't have enough cash to cover these massive losses. We are forcing you to buy the stock right now to close your position.
Right. It's a forced liquidation. So you have a stampede of short sellers forced to buy the stock at any price just to survive. That blind, panicked buying creates a violent feedback loop that accelerates the price upward at an unnatural speed.
Wow.
That is the physical mechanism that drives the price to that extreme 1.618 level.
So in the real world, when a crab is completing, you have total euphoria on one side. The financial media is hyping the breakout, greed is maxed out, and short sellers are being violently liquidated. The price is stretching like a rubber band pulled to its absolute tearing point, and the harmonic trader is just sitting quietly at the 1.618 line with their net, waiting for the rubber band to snap back.
It is the ultimate contrarian approach. But again, the market isn't static. It evolves. And as we dig deeper into the methodology, we see that institutional players, the smart money, they eventually realized retail traders were using these classic patterns. So they adapted. They started hunting them.
And that adaptation is what created the shark pattern. The shark completely breaks the traditional rules we just talked about. In the standard patterns, the middle peak of the M or W never breaks past the very first starting point. But in the shark, it intentionally breaks it.
The shark is an aggressive predatory anomaly. The metaphor I like to use is a hunter intentionally snapping a dry twig in the forest to make the flock of birds scatter. In the financial markets, liquidity, which is really just a massive pool of waiting buy and sell orders, that liquidity often rests just above old highs or just below old lows.
Because that's where everyone puts their stop losses.
Exactly. The shark pattern visually represents the institutions faking a breakout. They intentionally drive the price just past the old high. This triggers everyone's breakout buy orders, and it simultaneously hits the stop losses of the people betting against the market.
The snap twig.
The snap twig. The institutions scoop up all that panicked, clustered liquidity. They use it to fuel their own massive orders and then violently turn the market back in the opposite direction. It's a purposeful liquidity grab that leaves retail traders completely stranded.
But the beauty of this system is that the chaos of the shark actually sets up the safest pattern of them all, which is the 5-0 or 5-0. After a shark flushes everyone out and creates this extreme volatility, a new legitimate trend usually emerges.
And the 5-0 pattern is how you safely board that new train. While most of the patterns we've discussed rely on extreme numbers, like the 0.886 or the 1.618, the 5-0 isolates the exact perfect midpoint, the 50% retracement or the 0.50 level.
So you have this massive impulse move in a new direction, and the market gently pulls back exactly halfway, creating a perfect geometric lightning bolt shape.
It's a stunning display of market symmetry following absolute chaos. By waiting for that perfect 50% pullback, you aren't trying to catch the falling safe of the shark. You are safely catching the strongest, most stable part of a newly confirmed trend.
Okay, so we have all these shapes, we know how to identify the traps, and we know how to calculate the PRZ net. But here is a practical problem. Sometimes these setups take weeks or even months to form on a chart. What is a trader supposed to do while they wait for the price to actually reach the reversal zone?
That leads to one of the most revolutionary theoretical shifts in the methodology, which is the BAM theory. That stands for Bat Action Magnet Move.
I love this concept. The D point, the final target, it stops being just a destination and becomes an actual magnet.
In classic harmonic theory, you just sit on your hands and wait. But Carney realized that once the market validates a specific structural point, especially the B point in a bat pattern, the probability of the pattern completing skyrockets. The D point develops an incredible gravitational force.
So traders don't have to just sit on the sidelines. If they spot a massive bat pattern forming on a weekly chart, and the price definitively breaks past that middle B point, they know where the magnet is pulling. They can drop down to a smaller time frame, like a daily chart, and actively trade the trend right into the PRZ collision course.
It completely expands their arsenal. They aren't just reversal snipers waiting in the bushes anymore. They become skilled trend followers who possess the exact GPS coordinates of where that trend is going to hit a brick wall.
So what does this all mean for the moment of truth? Because finding the PRZ is great, but as the source material makes very clear, the modern market is noisy. High-frequency algorithms know where these harmonic numbers are, and they will try to intentionally spike the price to shake you out. How do we actually pull the trigger without getting run over?
If we connect this to the bigger picture, drawing the geometric lines and calculating the PRZ box is really only phase one. The mastery of this system comes down to phase two, which is terminal price action, the actual execution.
Right, because you don't just place a blind limit order inside the PRZ box, close your laptop, and walk away to play golf.
You absolutely cannot do that. You must watch how the individual price candles behave the moment they enter your mathematical net. You need to see visual proof of exhaustion.
For our listeners trying to picture this, what does exhaustion actually look like on a chart?
You're looking for what traders call wicks. If a price candle on a chart looks like a solid rectangular block with a thin line poking out the top or bottom, that thin line is the wick.
Okay.
It means the price pushed deep into that extreme Fibonacci level, but the momentum instantly died and the price was violently rejected back down. It shows a severe deceleration of momentum.
The falling safe hit the net and the ropes held.
Exactly. On the flip side, if the market smashes into your PRZ box with a gigantic, full-bodied block of a candle and absolutely no wicks, meaning no signs of slowing down, the momentum is simply too strong. The methodology teaches you to entirely cancel the trade.
Wow. Just walk away.
Yeah. The math gives you the window of opportunity, but the real-time price action grants the final permission to act.
And to help cut through that modern market noise, the methodology also introduces some advanced indicators. Because standard tools, like the MAFS-ED, are usually lagging. They're looking in the rearview mirror, which means they don't line up perfectly with these geometric structures that are looking ahead.
Right, which is why Carney developed the Harmonic Strength Index, or HSI. It is an indicator explicitly designed to be highly sensitive to the exact extremes where harmonic patterns complete. When price enters a violent grab pattern PRZ, you want to see the HSI entirely pegged at an extreme level, and then vividly cross back toward the middle at the exact second the price hits your 1.618 mathematical line.
It's verifying structural exhaustion and momentum exhaustion simultaneously. There's also the RSI BAM, which applies geometric trend lines to the momentum indicator itself, allowing you to front-run shifts before they even visibly show up on the price chart. It's wild.
It elevates the analysis to a level that is essentially invisible to the rest of the retail trading world.
Which really brings us to the most critical factor of this entire deep dive. We've talked about math, geometry, and algorithms, but ultimately, this all connects back to the psychology of the person sitting alone at the screen. Harmonic trading is clearly not for the impatient gambler looking for a quick dopamine hit.
Not at all. It requires the meticulous mindset of a sniper. It is for the person willing to wait for weeks, tracking a setup, only to let it go if the math isn't absolutely flawless.
And there's a golden rule here that I think applies to a lot more than just trading. The market is either perfectly harmonic or it's not.
That is the hardest part for human beings to accept. We want action. So traders try to force the market to be harmonic. They see a sloppy, lopsided W. They bend the Fibonacci rules to justify a trade. They ignore a B point that is slightly off.
Just to get in on the action.
Yeah, but the methodology strictly forbids this. If it's not perfect, you don't trade.
Which guarantees you will miss moves. I mean, the market will drop, reverse a few pennies before it hits your PRZ net, and take off without you.
And the amateur will get angry, chase the price, and usually lose their money. The professional harmonic trader will just delete the drawing, close the chart, and calmly look for the next setup. Because when you do find that perfect mathematical alignment, you operate with supreme confidence. You completely eliminate the guesswork.
Because you know exactly where your stop loss goes, just past the extreme outer boundaries of the PRZ box. If the net breaks, you're out immediately with a tiny loss. And you know exactly where your profit targets are. You completely eliminate the fear.
It truly is a comprehensive lens through which to view math psychology and the hidden mathematical order governing money.
Even if our listeners never place a single trade in their lives, just understanding that the madness of crowds, the panics, the manias, the bubbles actually has a measurable geometric rhythm is a mind-bending takeaway. It totally changes how you look at group behavior, whether it's the stock market or a crowd running from the rain.
It really does. And honestly, this raises an important question. If the chaos of mass human greed and fear in the financial markets can consistently be measured, mapped, and even predicted by ancient, naturally occurring geometric ratios, are our collective emotional reactions ever really free will? Or are we all just biological algorithms playing out our inevitable part in a mathematical sequence?
That is, well, slightly terrifying. Are we making a conscious choice to hit the buy button? Or were we mathematically destined to do it the moment the crowd shifted? Something for all of us to chew on the next time we feel the sudden urge to follow the herd. Thanks for joining us on this deep dive, and we'll see you next time.